It's the end of what has been quite a remarkable week for European markets. Stock market volatility at its lowest in 5 years, Italian bond yields their lowest in 2 years, and the euro back above 130. But is this as good as it gets? I'm Jamie McGeever and this is today's Market Pulse. We start though with ChartPoint, which today focuses on euro-yen, the single currency rising to a fresh 7-month high this morning, with traders citing month-end demand to buy euros from Japanese importers. Against the dollar, the euro is above 130, near a 1-month high. I spoke earlier to Adam Cole of RBC Capital Markets and asked why the euro isn't lower, given the eurozone's deepening recession.
Our best guess is that the counterfactual, where the euro might be if the crisis hadn't happened, is that it would be somewhere between 165 and 170. And I think that gives you a measure of just how big the risk premium is and, as a result, how much news it takes to get the currency moving down.
That's an opinion I'll now put to Michael Hewson, market analyst at CMC Markets. Well then, Michael, euro at 170 and a 40-cent risk premium in there. Do you buy it?
Not really, Jamie. I have to say, I mean, it's easy to make that argument, and I can sort of see Adam's point. But you know, we are where we are, and you know, I think actually euro-dollar should be an awful lot lower if you look at the rate differentials. If you look at Spanish bond yields, yes, they are a little bit lower at the moment. But I certainly think there's more potential upside in Spanish bond yields than there is downside, given the fact that we're getting deteriorating economic fundamentals coming out of Spain as well as Italy. France is probably the next shoe to drop with respect to that, and the economic data continues to deteriorate.
OK, the economic data is getting worse, but European stocks are on for their 6th monthly rise in a row. That doesn't suggest investors are particularly concerned.
No, it doesn't, or they're very complacent, one or the other. But let's look at where European stock markets have been over the past 4 to 5 months, Jamie. They've traded sideways, essentially. We made 3-month lows this month in November, and we're just off the September highs. So we've not really gone anywhere. Yes, we've closed, or we'll look set to close for the 6th month up in succession. But in the context of where we were at the beginning of the year, we've gone nowhere.
So what do you do then between now and the end of the year? I presume from what you're saying you'd be a seller of stocks and a seller of Italian and Spanish bonds.
Pretty much. We're at the top. We're sort of approaching the top end of the trading range that we've seen in European markets over the last 6 months. I still think that you've really got to have a bit of a defensive bias going forward. I certainly think there's more downside in euro-dollar than there is upside, and I certainly think, given the current uncertainty, not only over here in Europe but also in the US, you really have to adopt a slight defensive posture. And you made the point yourself, Jamie. Volumes are very low, which suggests to me that investors are sitting on the sidelines.
OK, Michael, thanks very much and have a good weekend. In today's stock check, Bankia by far the biggest loser. The Spanish state-owned bank shares ticking back up now after falling nearly 30% this morning. Trading was suspended on Wednesday ahead of a presentation of the bank's restructuring plan before the European Commission. Bankia said it would shed €50 billion of assets, with shareholders contributing some €10.7 billion to the clean-up. LVMH shares, though, on the up. The French luxury group, one of the top gainers on the FTSE Euro First 300, after Goldman Sachs upgraded it to buy from neutral, forecasting an improvement in demand from China. Finally, on this day in 1999, giant oil producers Exxon and Mobil, both descendants of the John D. Rockefeller Corporation, joined forces to create ExxonMobil. Not only did this produce the largest of the 6 oil supermajors, but one of the largest publicly traded companies by revenue and market cap in the world. That's today's Market Pulse. I'll leave you with a pick of the day. Greek pensioners furious at the way the country's debt crisis has dashed hopes of a comfortable old age. Read about how Greece's pension funds have been savaged by austerity in a Reuters special report out today. I'm Jamie McGeever. This is Reuters.